Hi, I'm David Traversi, and this is part of our series called How to Sell Your Business. We've been discussing valuation, and today's episode is going to discuss some basic terms. It's not the most exciting material in the world, but it's very important when you're talking about valuation in mergers and acquisitions. First term is EBITDA. That's EBITDA. EBITDA. This is the cash flow generated by a business in a defined period. It's formally defined as earnings before interest, taxes, depreciation, and amortization. Drawn from the income statement, you take net income, that's revenues less expenses. You add back interest, taxes, and the non-cash expenses of depreciation and amortization. It's a definition of cash flow used almost universally in M&A transactions. The next term is purchase agreements. Sales of companies are ultimately memorialized in a written contract. If the transaction is an asset sale, which we'll discuss below, the agreement is usually called an asset purchase agreement, or APA. If the transaction is a stock sale, also discussed below, the agreement is usually called a stock purchase agreement, or SPA. And oftentimes the document is just called a purchase and sale agreement, or PSA. The next term is comparables. In the M&A world, these are usually businesses or companies that are similar to the business being sold. There is never an identical company, so the relevance of the comparable company is increased the more it is similar to the business being sold in terms of type of business, business model, size, location, profitability, and any other material features of the business. Our next term is asset sale. Sales of businesses are structured as either an asset sale or a stock sale. In an asset sale, the seller remains the owner of the legal entity and retains long-term debt obligations unless they're specifically assumed by the buyer. The cash in a business is normally not included in an asset sale. Next term is stock sale. In a stock sale, the buyer buys the entity and receives all the assets and assumes all the liabilities, subject to any negotiated exceptions. Again, the cash in a business is normally not included in a stock sale. Working capital is another important term. This is generally a company's current assets, in other words, liquid assets or assets that are expected to be liquid in less than a year, less its current liabilities, liabilities that are payable now or will be payable in the next year. So current assets usually include cash equivalents, accounts receivable, and inventory. Current liabilities usually include accounts payable and any amounts of debt payable that are due in the next year. For the third time, I'll mention, but well worth it, cash is usually not included in the sale of a business. The last term to discuss right now is normalized working capital, the normal level of working capital necessary in the ordinary course of business. This is part and parcel of a stock sale, and it's usually included in an asset sale, even though it includes the accounts payable liability. Thank you, and look for future episodes of How to Sell Your Business.